Students, welcome to my class, and as I said, I'm just giving the solution to the multinational capital budgeting question that I passed to you in the previous video. The first question that is asked here is, see, they've asked you to determine the net present value of this project and should the company accept this proposal. Basically, if I have to determine the net present value, I have to find out the present value of cash inflows and the present value of cash outflows. And when I say NPV, cash inflows in this case is nothing but your cash flows after taxation and before depreciation. Okay, so let's go to the first part of the question, that is to determine the NPV of this project and whether the company should be accepting this proposal or not. Okay, so I've just taken this in a different sheet. Please understand. The heading would be to determine the net present value of the project. Okay, particulars year 1, year 2 and year 3, because the life of the asset is only for 3 years. Total revenue. So usually I am very sure you guys must be knowing about the marginal cost statement. We start with sales and then we go ahead to deduct all the costs and then arrive at the EBIT, add back the depreciation, right? So what we do over here is to take the total revenue. What is the total revenue in this case? Price multiplied with the demand. Price is given to you and the total demand is also provided to you. Okay, so this is what I meant to say. So look at this. This is the data that is given to you. And I have taken the price as well as the demand. 600 into 40,000 is 2 crores 40 lakhs. So we have simplified it and taken it as 24. Likewise, 650 into 50,000 is 3 crores 25 lakhs, 32.5. And 700 into 60,000 is 4 lakhs 20,000, which is 42. Less fixed cost. Fixed cost is given to you, that is 5 million. As it is, I've taken 5 million. Less variable cost. How did we take variable cost? Look at this. In the question, they have given you the variable cost. French francs is 25, 30 and 40. So therefore, on the total number of units that is demanded, I've taken 600 into 25, which is 15,000. Right? I think there is a mistake. Let me check. 25 into 40,000. I'm sorry. Okay, it is 25 into 40,000. I just have to copy down this portion. I'll just take it here. Yes, it's perfect now. So therefore, we have around 10 lakhs, 15 lakhs and 24 lakhs, which is taken as variable cost 1, 1.5 and 2.4, right? Okay. Besides that, we have depreciation. Depreciation is charged for 10 years on 60 million. And the method used is the straight line method. So therefore, the depreciation is going to be 6 million every year. So once I deduct all this, okay, 5 plus 1 plus 6 is 12. So 12 minus 24 is again 12. Okay, that's how we got 12. EBIT, earnings before interest and tax, is therefore equal to 12, 20 and 28. Less interest paid. Okay, let me change the spelling of interest here. Interest paid on the working capital, the rate of 10% on 10 million is 1. So 10 lakhs into 10% is 1. I've just taken as it is. And interest is a financial expense. Okay. Then we have the profit after tax. Sorry, after interest and taxes. But before interest, after interest, but before tax. And before tax, let me write this as, okay. So therefore we have 11, okay. 12 minus 1, 11, 20 minus 1, 19, 28 minus 6, 1, 27. Add back the depreciation. I told you very clearly, in case of the NPV, cash inflows in case of NPV is always equal to cash flows after taxation, but before depreciation, okay. So we have to consider the value that we have taken over here. So add back the depreciation 6. So 11 plus 6 is 17, 19 plus 6 is 19, 27.6 plus 6 is 33.6. Salvage. Salvage is the total amount that you're recovering at the end of the life of the asset. So therefore, that's given to you as 42 in the question. So we are taking it as it is. So the total cash flows, what we're getting is 17, 19 and 75.6. Okay. less withholding tax. I've already explained to you what is withholding tax, and that is given to you at 10%. So 10% of 17 is 1.7, 10% of 19 is 1.9, and 10% of 75.6 is 7.56. So the remittance is 15.3, 17.1 and 68.04. Present value. Now present value will have to be considered. Now usually what we do is, this is nothing but your cash inflows. To your cash inflows only, no, this is in other words cash inflows. To your cash inflows, what we do, we have to take the discount factor. Only when you multiply it with the discount factor, you get the present value of cash inflows, right? So we have to find out what is a present value at the rate of 15%, because in the question they have very clearly given you the discount, the required rate of return on this project is 15%. So therefore we are taking the discount factor at 15%. Now 15.3, 17.1 and 68.04 is a net remittance. Okay, now present value at 15%. How do you get that? Now look at this. 1 divided by 1.15 is 0.8695. Okay, I'm just reducing this further. Look at this. I'll just reduce it and you'll get the value. So if you multiply 15.3 into 0.870, you get 13.30. 0.756 multiplied with 17.1, you get 12.93, and 0.658 into 68, we get 44.74. That is what is written over here. Yeah, this is the present value. Okay, so we have taken the discount factor and then directly calculated the PVCI or PVCOF in this case, right? PVCIF in this case, I'm sorry. 13.3 and 12.93 and 44.74. Forward exchange rate given to you in the question, because we have to convert the French francs into dollar. And the dollar rate is given to you in the question, which is 0.22, 0.25 and 0.28. Okay, so we have taken this, and therefore the present value, which is now in terms of dollar, is 2.93, 3.23 and 12.53. Okay, so therefore PV is equal to present value of net cash flows minus the initial investment. What is that we have to do is to add back all the 3 years PVCIF, 2.93 plus 3.23 plus 12.53. Okay, minus the total initial investment is 12. Okay, and therefore when I deduct minus 12, so this is equal to this plus this plus this, right? So 18.69 minus 12. So this is equal to, let me check once again to be more clear about, yes, it is 6.69 million. So this you can use it for your working notes, right? And yeah, we found that the NPV is 6.69, which is definitely a positive answer. So we can say that since the present value of investment is positive, the company should invest in the project. Okay, so this solution is going to be little lengthy, and therefore I'll just send the second part of the solution in the next video. Thank you guys.